Welcome to the Finance Podcast. The topic of this episode, Navigating Equities in the Last Mile of Inflation by Pierre Debroux from Wisdom Tree.
I'm the head of quantitative strategy and multi-asset solution at Wisdom Tree. Wisdom Tree is the largest independent ETF provider in the world with 100 billion of assets. And we have been investing in, we have been creating factor equity strategies for the last 20 years. So let's start a little bit with the outlook and where we are currently in the market. Obviously, we want to start with inflation. That's been the story for now 2 years, but it's still important. It's still driving a lot of the market sentiment. So clearly, at the end of the year last year, we were seeing inflation coming down a lot. The market was expecting a lot of rate cuts, therefore, from central banks. In the US, late last year, we were talking about potentially 7 cuts in 2024. But what we've seen is that this inflation has, in Q1, has been more bumpy, I want to say. The inflation we had a few readings that were quite hot. And so this inflation going down trend has a little bit stopped. And so that has completely changed the mood in the market from a quite optimistic mood with, as I was saying, expecting 7 rate cuts to now a mood which is a lot more pessimistic with right now only 2 cuts expected for 2024. So that's quite a sharp change between 7 cuts to 2 cuts. In fact, if you read a little bit different analysts, some analysts are even talking about potential hikes. So that's obviously quite a different tone. And that has driven the stop in the rally. So we had a January, February, March rally. April, we've seen quite a lot of downtrend into equity market. So that's for the inflation. When it comes to the economic forecast, early in the year, the IMF had revised their growth expectation up, being quite positive for the US with around 2% of expectation for growth in 2024, revising up for China at 4.6, even if China is still quite low compared to historical average. But they were, in their report, they were saying, there is still downside risk on the growth side because of potential geopolitical shock, potential sticky inflation. And that was early in the year. We are now in April, and we are seeing this thing happen. So we are seeing the geopolitical risk getting higher and higher with the situation in the Middle East in particular, with the situation in Ukraine and Russia not getting any better. And we are seeing all those disruptions in terms of supply chains in the Red Sea and so on. The inflation is also sticky. So we are seeing a lot of those risks that the IMF was pointing that could lead to a little bit less growth than what they were anticipating materializing. And so that means that the recovery or the global recovery is going to be quite slow. The positive side, I guess you could argue, is around the purchasing manager indices. If you look at the PMIs around the world, they've posted quite strong numbers. In the US, we had a surprisingly high PMIs in the early part of the year. The Chinese PMI have been rebounded since the new year. The Eurozone PMI are going up as well. So from a pure economic point of view, we are seeing that the activity is picking up a little bit. So it's not all doom and gloom, but what we are seeing is this picture which is quite uncertain. If we look a little bit more closely to the US, what we are seeing is that retail sales, which had been a strong support for the US economy in 2022-2023, are slowing down. And the reason for that, in part, is that the savings from US retail have been disappearing, right? A lot of money had been saved in the COVID crisis. A lot of this money has been now spent. If we look at the level of savings for consumers in the US, it is now quite low. And so there isn't a lot of runway left for US retail to support the economy a lot further. So I was talking about the rate cuts. The expectation of rate cuts was a very strong support to equity markets in late 2023, in early 2024. As I was saying, we were market was pricing in 7 cuts, but now that has completely shifted. When I did this graph 10 days ago, it was showing 3 cuts. Now, if you look at this morning, the market is pricing 2 cuts. So we are moving more and more towards a very small number of cuts, if not any cuts, in 2024. And of course, that has removed a lot of support from the market, which explains a little bit the negative performance we've seen in the last few weeks. And that's in the US, but we have the same kind of scenario in Europe as well. So what does it say what all of this tells us is that there is a lot of uncertainty around the trajectory of equity markets going forward because of the uncertainty around the trajectory of inflation, because of the uncertainty around the trajectory of the rates in the US and in Europe, and because of the uncertainty around the strength of the economy and the growth in the face of the sticky inflation, in the face of higher for longer rates, and in the face of all of the increased geopolitical risk that we are seeing. So that means that from a pure equity positioning, we are quite conservative, but in the sense, not that we are coming out of equity, but in the sense that we are careful about where we are going in equities. Why are we not going out of equities? Is because there is still some technical signals that are quite bullish. One of them is that Q1 was still a positive quarter for equities. In fact, it was the second quarter in a row with double-digit returns for US market. It is quite rare to have 2 quarters of double-digit returns in equity markets. It only happens around 18, 19 times in the last 100 years. And usually when that happens, it means that the rally still has some way to go and you still get a few positive quarters after that. So that's one of the technical reasons why we are still remaining invested in equities, is that while there is a lot of uncertainty, we don't think there is like an imminent drawdown coming in, but there is a lot of uncertainty, and so we need to be careful about how we position ourselves in the market. The second technical sign that we see, which is relatively positive to the current bull market, is that the market breadth is improving. 2023 was all about the Magnificent Seven and how the Magnificent Seven were driving the equity market performance up. This was less the case in Q4, and this was not really the case in Q1. So we've seen the market breadth improving a lot in 2024, and that's usually, again, a positive signal for a bull market. It means it's well supported. It means that there is a bit of potential for it to continue. And finally, it's worth remembering that we have the US presidential election coming into November. And if you look at the behavior of equity markets in presidential year in the US, what we observe is that you have a pretty tepid second quarter, third quarter, but the fourth quarter tends to be quite strong because a lot of the uncertainty created by the election is removed from the market. So that's also, let's call it a technical sign in some way, that the equity market could still go up. So what does that mean for us? It means we think there is still potential for the equity to continue to make gains, but again, a lot of uncertainty. And so how does that translate for us in terms of positioning? That translates into we want to position in equities, but in a way that is quite we call it all-weather, meaning quite at the same time defensive, but being able to participate in the upside. So that's usually for us means in quality stocks, right? Just before I go into that a bit more, the right-hand side graph is interesting. It shows the performance of high quality and low quality stocks in presidential year. You can see high quality in light blue, low quality in gray. And you can see that in presidential year, there is even more of a gap between high quality and low quality. Over the long term, high quality stocks tend to outperform low quality stocks. In presidential years, they tend to do so even more. Why? Because there is more uncertainty, right? And usually in uncertainty, that's when quality does quite well, because you have this behavior from investors that prefer to hold companies they feel secure in when there is uncertainty. So that brings me to why do we look at quality stocks, both in general and in this current period of uncertainty. First, quality is an interesting way to look at the market because it is both recognized by academics and not practitioners, right? If you think about academics, quality is recognized as a factor. It's part of the 5-factor model from Fama French, for example. It has been recognized as a factor for more than 50 years now. But if you look at practitioners, so basically active managers, if you look at the way they invest in stocks, quality is always part of the process, right? If you're talking to a value manager, a growth manager, they'll tell you, okay, I look at stocks that are cheap, or I look at stocks that are growing fast. And then at one point they'll say, and in that universe, I pick the high quality one, right? I've never met an active manager that says they take the crap companies, right? They always take the high quality inside the universe that they invest in. So you have this agreement, if you want, between academics and managers around quality. Historically, quality has outperformed the market. I'll show that. But the way quality has outperformed the market is interesting because the outperformance is what we call all-weather, meaning that it's not too cyclical, not too defensive, but it's still a little bit defensive, which is what you want into a strategic investment in equities. And what's really interesting about the defensiveness of quality stocks, it is that it is behavioral, meaning that it is the result of investor behavior. If you think about what happens when the market is going down, when you have a lot of volatility, a lot of uncertainty, investors, they tend to come out to the stocks that they feel the less secure about. So that tends to be the cheap stocks, that tends to be the stocks that have low quality. And they go to the companies that they know, the companies that they feel secure in, the companies that they feel won't lose as much money as the other one, and that's the high quality stock. So you have this tailwind of investors going from low quality to high quality during crisis that makes high quality defensive in those periods. So that's really interesting for a long-term investment as well. So if we look at quality, that's the work from academics, right? It's not my data, it's Kenneth French data, so the French in Fama French. And you can see here for global equities, but it's the same for US, it's the same for Europe. You have in light blue, low quality, gray is the high market, and dark blue is high quality. So you see that high quality outperforms the market, low quality underperforms the market over the long term. And what's really interesting is that high quality outperforms with less volatility when low quality underperforms with more volatility, right? So you have this very nice long-term behavior that makes quality a nice long-term core equity exposure. We call quality all-weather. Why? Is because quality is not the only factor, right? Small cap is recognized as being a factor that outperforms over the long term. Value as well, low volatility, and so on, right? But the big difference is that some of those factors, they have a very clear behavior. So if you think about small cap, for example, they are very cyclical. So if the market is going up, they'll do better than the market. If the market is going down, they'll tend to do worse. Low volatility is very defensive. If the market is down, they'll do better. But if the market is up, they won't be able to do as well as the market. So that's not the case for quality. Quality is a bit more in the middle than that, and it makes it quite consistent over time, right? Here we are showing, again, it's still Kenneth French data. It's US equity data from the 1960s, so 60 years of data. And we are looking at the outperformance of different factors over 10 years period, right? What we see is that small cap outperform in 58% of the 10 years period. Value outperform in 74% of the 10-year period. So there are factors, they outperform over the long term, but they don't outperform all the time, right? Quality outperforms 90% of the 10 years period. So it's a lot more consistent. It outperforms a lot more of market scenarios, right? It outperforms in more part of the business cycle, which makes it quite consistent. And if you look at the worst underperformance versus the market, it's also the smallest one, right? So if you look at the graph, the dark blue line, which is quality, you see it's quite consistent over time. And so that also makes it quite interesting as a factor for period where there is a lot of uncertainty, meaning where you don't really know in which part of the cycle you are, you don't really know what could be coming next, and also very interesting for a strategic investment. I mean, looking at, again, this all-weatherness, here we're looking at the average outperformance of quality versus the market in different parts of the business cycle, so early recession, late recession, early expansion, late expansion, and again, we see that quality is able to outperform in those 4 parts of the business cycle, which is not the case for other factors. Other factors are going to outperform in some part of the business cycle, underperform in others. Quality is a lot more consistent than that. Now, moving on a little bit to the way we think about quality ourselves, right? There's a lot of ways to define quality. There is a lot of ways to build a quality equity strategies. But the way we think about quality maybe is a bit different, and it's kind of linked to our history. Initially, we were a bit of a dividend managers, if you look at us 25 years ago. But what we notice is one thing, that if you look at quality, at all the quality stocks that exist, one potential drawback you could notice is that it's quite techy, right? Especially now, especially in the US. If you look at all of the Magnificent Seven, all of the tech stocks, they're quite high quality, right? Because if you look at Google, if you look at Amazon, if you look at this type of company, they don't have a lot of debt, they generate massive amount of cash. So over most quality metrics, they score very high. But it would be very, very hard to argue that Amazon is not a cyclical company, right? And so that's potentially the thing you have to keep an eye out when you invest in quality, is that it's easy to be a bit growthy, right? It's easy to be a bit tech, especially in the US market. Now, what we noticed and we found very interesting is that if you move a little bit and you think about dividends, right? We know that dividend payers, over the long term, they outperform non-dividend payers, right? We also know that dividend growers, they tend to outperform dividend payers, right? So the best place to be from a dividend point of view is in dividend growers, right? What's interesting is that if you think backward, what is a dividend grower? It's a company that has paid dividend more and more every year for the last X years, right? Fine, that's easy enough. But if you look forward, right, and you're saying, I'm looking at a company, is this going to be a dividend grower in the next 10 years? How do you decide that? To us, it means you are growing your earnings, it means you are generating more and more cash, the company is growing, the company is more profitable every year. It's kind of the same as high quality, or at least there is a huge overlap between what you need to be high quality and what you need to be a dividend growers. But it's not a full overlap, because you have some high quality companies that cannot be dividend growers because they don't pay dividend, right? And so the way we think quality is we think quality and dividend growth, right? The product that Johannes was mentioning was quality dividend growth, is because it's quality and dividend growth at the same time. And so it gives us a quality portfolio, but at the same time, because it's combined with dividend growing companies, it removes a little bit of the tech, it removes a little bit of the cyclicality. So that's basically the philosophy of the strategy that we developed, which is to focus on dividend growers because they're high quality companies. It allows us to tap into the all-weatherness of quality, the outperformance of quality, the defensiveness of quality, but through this angle of dividend growth. It is a strategy that we created a bit more than 10 years ago. Globally, we have 18 billion of assets that are tracking those strategies in different wrappers. In Europe, we have 4 UCITS ETF, one focused on developed equities, US equities, Eurozone equities, and UK equities. So 4 different wrappers. Global US and Eurozone, they have been launched in June 2016, which means that we are coming up on 8 years of track record now. UK is a little bit more recent. And we can see here that the global is 5-star rated Morningstar, the US is 5-star rated Morningstar as well. They all outperform the benchmark over a long period of times. So really, they've delivered of what we were expecting them to do to be this all-weather strategy. So how do we build a high-quality dividend-growing company? An high-quality dividend-growing portfolio, right? First, we start from dividend-paying companies. So that's a first twist compared to a lot of quality managers, is that we are not considering non-dividend payers. So we are not considering Amazon, we are not considering Netflix or Adobe, for example. It's just dividend payers. Then we apply an ESG filter, which is based on Sustainalytics data. It's based on activities, right? So we remove controversial weapons, we remove companies that are involved in tobacco, in thermal coal, in unconventional oil and gas, in small arms. And that means that the ETF is rated SFDR Article 8. And then the step 2 is what we call risk filtering, which is about cleaning the universe from the worst stock. How do we define worst stocks? Is we rank companies by momentum and quality, and we remove the bottom 10%. So lowest momentum, lowest quality are removed. We also have a special focus on very high dividend yield stocks. So we look at the top 5% by dividend yield. Elevated dividend yield is risky. Why? Because dividend is a discrete number that is published every quarter, every 6 months, depending on the location, when price is daily, right? And what you can have when you calculate the dividend yield is you can have a dividend that dates from 2 months ago, a price which is today, and the dividend yield can be the result of the price going down a lot, right? And so what happens for a lot of companies is they pay a dividend, the price goes down a lot, the dividend yield therefore goes up and up and up, but at the next dividend payment, they lower the dividend a lot so that the dividend yield comes back to the level it was 3 months ago. So elevated dividend yield needs to be looked at with care. And so what we do is we say for companies that have high dividend yield, we are not removing the bottom half by momentum and quality. We're not removing the bottom 10%. We're removing the bottom half, right? So we remove really all of the low momentum, low quality in that dividend yield, in that high dividend yield box. Because if you have high dividend yield, you should have high momentum, high quality. And then step 3 is very much where we do the portfolio selection. We pick 600 stocks for the global product based on earning growth, return on equity, return on assets. So return on equity, return on assets is how Fama French defined quality. So it's very much through profitability. And if you combine estimated earning growth, return on equity, and return on assets, to us, this is how you think about being able to grow your dividend in the future. You're growing your earnings, you are very profitable, you're going to be able to pay more to your investors over time. So you end up with a high-quality, dividend-growing companies using those filters here. In the US ETF, we use only 300 stocks. In the Eurozone ETF, we use 100 stocks, but just because of the size of the universe, the logic is the same. And then when it comes to the construction of the portfolio, we've selected the 600 stock. How do we weight the stock between each other? Here, we use cash dividend paid. So what does that mean? Cash dividend paid is the total amount of cash that has been paid by the company to all shareholders as dividend. So it's the amount of cash that comes out of the balance sheet as dividend. Why do we use this measure? We use this measure because we want to reward companies that pay more dividend to get more weight. But we are very careful not to use dividend yield as a weighting agent, because dividend yield doesn't take into account the size of the company. So you could have a very small company with very high dividend yield. It would get a huge weight, and it would create a huge small cap bias. And obviously, small cap is very cyclical, so it would a bit kill the concept of being all-weather, right? So we use cash dividend paid, which at the end of the day is market cap multiplied by dividend yield. So it takes into account the dividend yield, but it also takes into account the size of the company. And so we get here a bit of a more weight for companies that pay more dividend, but in a way that doesn't create a small cap bias. And finally, we have portfolio diversification here. Just about diversification is just about making sure the portfolio is diversified. We cap individual stock at 5%. We cap countries at 25%, except the US, which is capped at 60%. And we cap sectors at 20%. We are not sector neutralizing to the benchmark, right? We are going to be overweight or underweight to the benchmark. We are just making sure that we don't have 50% in healthcare, for example, right? So if you look at the track record of the product, I said we launched it in June 2016. So that's live track record of the ETF net of fees. So that's after fees have been paid. And you can see that over the last 8 years, basically, we outperform a little bit the benchmark with less volatility as well. So very, very close to what you would expect from the quality factor, as we've seen in the first few slides from Kenneth French. From a Morningstar point of view, I said we are 5-star Morningstar, right? Wanted to show you a little bit how we compare to the peers. Here we compare to all of the ETF, but also all the mutual fund in the global large cap blend peer group. So the global large cap blend is quite a big peer group because you have more than 2,000 fund and ETF. And you can see that we are top 19% over the last 5 years. So long term, we've performed quite well, beating a lot of the peers, both passive and active. But what's really interesting, I think, is this one. So having a great performance over the long term, this is good. But at the end of the day, we designed this strategy to be core, to be strategic, to be consistent, right? And so we wanted to test the consistency of the strategy. So how did we do this? We said, OK, let's look at all the rolling 12 months period of that the ETF has been live since 2016. And let's look at how many of those 12 months period do we outperform in and how many do we underperform in, right? And we noticed that we outperform in 68% of the 12 months period. So basically around 2/3 of the time we have outperformed. If you compare that to all of the ETF and all of the funds that are in the global large cap blend peer group, what you see is that this is top 1% in terms of consistency. There is only 1% of stocks, 1% of 1% of strategies in that peer group that has outperformed more often than 68% of the 12 months period, right? In fact, there is only 9 funds that have outperformed more consistently than we have out of 2,000 funds, right? So more importantly to us than the performance, the consistency is what we think is really important and really great in the track record of the strategy, that it has delivered this consistency over the long term. If we dig a little bit into the portfolio, so as I said, around 600 stock. Here we have a little bit less because you always have corporate action. You also have the ESG filter that is applied quarterly, can remove a few stocks. What I want to highlight first is that the active share to the benchmark is 64%, right? So I've been talking about the strategy. It is an ETF, but it's not passive, right? It is quant systematic, if you want. So it's very different from the benchmark. There is a 64% active share. If you look at the top 10 of the portfolio, it's not at all what you would expect from the top 10 in the MSCI world. That's because the rules we apply makes the portfolio quite different from a pure Delta One product. If we look at the fundamentals of the portfolio, so I mentioned you have clearly very high return on equity, very high return on asset compared to the benchmark. What's interesting is that the forward price to earning remains quite contained despite those very high quality features. And that's the result of mixing quality with dividend growth. And you can see that the dividend yield is also a little bit elevated compared to the benchmark, which is also what we wanted to achieve. In terms of sector allocation, as I said, we are not sector neutral to the benchmark, right? We control with these caps, but the sectors can vary compared to the benchmark. What's really interesting about the sector allocation is that it is not a top-down decision, right? It is the result of the stock selection, so it's going to depend of where we find more quality stocks. And what's really interesting about this is that the sector weighting changed a lot over time. So it adapts a lot to market condition. So if you look at the current allocation, we are overweight staples, we are overweight healthcare, we are overweight industrial, and we are underweight IT, financial, and energy, for example. But if you look historically, you'll see that around 18 to 24 months ago, we were very overweight materials because we had a lot of miners. They've come out. We used to be quite overweight IT as well. Now we are a little bit less so. So the sector allocation is quite dynamic, which is really interesting because if you think about a lot of the dividend strategies that you could buy in the market, being either passive or active, they are going to be very fixed in terms of sector allocation, right? They are going to be long energy, long utilities, long real estate, because that's where the high dividend payers are. And this is not the case here. You're more the strategy adapts more to the market scenario and to the current market environment, and that's quite useful. In terms of countries, again, it's a result of where we pick the companies. So Switzerland right now is overweight. It's a result of having Nestlé and a lot of healthcare in the portfolio. UK is a little bit overweight because of some energy companies. France is a little bit overweight. That's because of luxury. So we have LVMH and L'Oréal that are picked in the portfolio. US is underweight. Why? It's mostly because of the cap, right? You see we cap at 60%. MSCI World, the weight of the US is going up and up and up, and now it's 70%. So we are a bit underweight. So I talked about the performance. I talked about the performance versus this very large global large cap blend peer group. A question we get a lot, and so I have this slide now, is how do you compare with other ETFs, right? So I put here a few ETFs names that come up a lot. The Aristocrats, for example, comes up a lot. The Amundi Quality Income comes up a lot, and iShares MSCI World Quality comes up a lot. So I think here it's important to stop and to really note a few things. If you look at the performance of the Aristocrats or the Quality Income, which are in yellow and purple in the graph, and you compare that to the dark blue line, which is us, or the gray line, which is the market, you can see a huge difference, right? That's because the strategies are quite different, right? Aristocrats, Quality Income, they are very much dividend strategy, pure dividend strategy. They are low quality strategy as well, by construction, because they focus only on dividend yield, because they only focus on who paid a lot of dividend historically, and for the last 7-8 years, that has not been the best strategy, and so that's quite obvious. I was mentioning the fact that our sector allocation is very mobile. Something like the Aristocrats has a sector allocation which is the same all the time, and they suffered a lot from that in 2020, right? Aristocrats is very overweight energy. When you have oil going to zero in 2020, that's going to hurt. And we see that in the drawdown of the Aristocrats, right? The max drawdown is 43%. That's the result of being overweight energy in 2020. In our case, we were not overweight energy at that point. So I think there's a big difference between us and the Aristocrats, for example. And the performance over the last 8 years makes that quite clear. A peers which is quite close is the iShares MSCI World Quality. It's an ETF which is focused on quality, but they don't have this dividend angle that we have. So it makes it a lot more tech. And you can see that in the fact that the volatility is a little bit higher. It's basically at the market level when we are a bit lower. It's a bit less defensive. But overall, it's a strategy that may be a bit closer. If we look a little bit at the difference between those two ETFs, so the MSCI World Quality from iShares and our quality, you can see here what the real difference is that if you look at periods where the MSCI World is negative, you can see that both strategies tend to outperform, right? So they are quite defensive, both of them, because of the quality angle. But if you look at what happens when the market is very positive, right, when the market does very well, you see that in dark blue, you see that we continue to be quite consistent, right? when the light blue, they have some period where you have very strong underperformance and some period where you have very strong outperformance. That's the result of the quality of the growth tech angles that they have, right? It means that when the bull market is a bit more value-driven, they're going to do terrible. And when the bull market is more growth-driven, they're going to do great. Because of the fact that we are more in the middle from a growth value angle, our behavior is a little bit more in the middle. And just to conclude, so this global ETF, as I said, 8 years of track record. It now has around 1.5 billion of assets. It's 5-star Morningstar. The total expense ratio is 38 bips, so it's quite aggressively priced for a strategy that is not Delta One. And you can see here that there is a lot of listing. You can access it through both distributing and accumulating share class, but also edge share class. And again, we have the US and we have the Eurozone ETFs as well. The US is priced at 33, and the Eurozone is priced at 29 bips. So with that, I mean, if you have any question, I'm happy to answer. Of course.
Thank you for your presentation at first. Page 17.
Okay.
How do you explain the differences in terms of outperformances by geography? Page 17.
Yeah. It's big. So the main.
Because my understanding is that you use the same method. So
yes, I
how
do.
do you explain?
Yeah. So the main difference is the makeup of the market. In the US, you have a lot more non-dividend payers. In Europe, it's almost all dividend payers, right? So when you apply the methodology to the market, there's slight differences in the portfolio you get. The US portfolio is going to be a bit more value because you're removing more stocks that are non-dividend payers, so you're removing more growth. In Europe, you're going to remain a little bit growth because you're not removing as much stock because there isn't as many non-dividend payers to remove. So that's and global is kind of in the middle from that angle, right? Because it's a mix of both. And that, if you look at the result, that explains a lot. If you look at the performance in different periods, you'll see that when the market is a bit more growthy, then Eurozone will do better, US will do a bit less well, and so on. But basically, it's the market structure.
How would this perform without the ESG screening?
It's an excellent question. So the ESG screen, in fact, came in 2020. So the first 4 years of track record doesn't have the ESG. So that gives us one idea. If you really want to know, it's easy because our US domiciled ETFs, they don't have the ESG. So they basically track the index without the ESG. And it's not very different. Short answer is, of course, if you look at one given year, you're going to have some differences. But long term, it's not super different. I'm not going to say it's outperformed. It's not the case, but like it's basically very similar. But if you do Bloomberg, both US, Europe, you'll see the difference.
Finally, the mandatory risk warning. The content of this episode is for general information only and is not a recommendation to buy or sell any financial products. All information is supplied without guarantee, and this is not an investment advisory.